Hi, I'm Pattu from freefincal. In this video, let's talk about why RBI increased the repo rate and how it will impact us and how it will impact our debt mutual fund investments. So, RBI increased the repo rate, that is the rate at which it lends to banks from 4% to 4.4%. It did it because the consumer inflation is close to 7%. So why did it do it? Now, when inflation increases, it typically means there is a higher demand for goods, and that's higher than the supply. That is, the demand for goods is higher than the supply. So we have a detailed FAQ post on how inflation affects our ability to manage money. If you are a complete newbie, I would suggest that you read this article. I'll try to link this article within the video. And we have explained here why a small amount of inflation is good for the economy, but it should neither be too low, that is close to zero, or neither be too high. So it should be somewhere in between too high and too low. For India, of course, what this low and high depends on the country. For India, RBI has defined the inflation to be within 2% to 6%. Anywhere between 2% to 6% according to RBI is reasonable, but it has gone past this target and it has gone close to 7%. That's the reason why RBI wants to act immediately, and to do that, what they have done is they have increased the rate at which the banks borrow money from RBI. This rate is known as the repo rate. We have another detailed article called Understanding Repo Rate and Reverse Repo Rate, why and how RBI controls money supply in the economy, and so on. I would recommend that you look at it. So this means that there is a higher cost for banks. Now they have to pay a higher interest rate if they want to borrow money. So there is a higher cost, and to offset this cost, automatically the banks will increase the rate of interest on their loan products. Home loans, car loans, personal loans, everything will become more expensive. The interest will become higher. So once the interest becomes higher, consumers will be wary. People will not borrow and spend. So they will borrow less. They will prefer to save rather than spend. Therefore, automatically what happens? There is a decrease in the demand. Then for product suppliers also, for them also the borrowing will become higher, the loans will become higher. They will also try not to grow their business at such a time, and they will try to maintain status quo and maintain the same level of supply. So therefore, gradually there is a decrease in the demand. So the demand for goods will fall, and if one rate hike does not do it, there will be subsequent rate hikes also in the coming months or even in the coming years, and gradually we will see the inflation to come down. That is, the demand will fall and become closer to the supply. So then there is something called the cash reserve ratio. This is the percentage of depositors' money the banks will have to mandatorily hold with RBI. This has been increased from 4% to 4.5%. So which means that banks have got lesser money to play with, they have lesser money to lend, and therefore again demand will be curbed further. Now the bank management may decide that instead of paying a higher repo rate to the RBI, they can hike the deposit rate, and anyway they are not going to immediately pay the deposit. It's going to be only after a few years, depending on the fixed deposit. They may decide to increase fixed deposit rates as well, because then more people will come and invest with them. Then they will have more money to play with. So they may decide that, and of course the increase in FD rate may not come immediately. It depends on the bank, how much they do. The margin will, everything will depend on the bank's individual business position, etc., and so on. Now, so again, if the fixed deposits increase, the saving will increase, the spending will slightly go down. Again, that will reduce demand for goods, and because the savings have gone. So that's basically why RBI hiked the repo rate, and you can see the repo rate history, the complete history, whatever is available in our article. We update this. This is a graph, and you can see that the data is updated here with every policy meeting, and posted here. You can have a look at it. I'll try to link this also. I try to link all these articles either within the video or in the description and in the comments. Now coming to debt mutual funds, now always remember that the NAV of a debt mutual fund is linked to the market price, the current market price of a bond. So if the interest rate has increased, now the repo rate is basically the overnight rate. It is the shortest duration interest rate. This doesn't mean the 10-year interest rate will suddenly increase and so on. No. This means that in the money market segment, where money is actually a commodity, people will demand a higher rate of return for lending money, because inflation is higher and they will the value of money is will erode due to inflation. They will demand a higher rate of return, and because of that, what will happen? The short-term bonds will immediately get affected. If you notice today morning, if you had seen, or you can see it even now, all the liquid funds have fallen down a little bit. Money market funds have fallen down a little bit. This is because the market is demanding newer bonds with higher interest rate immediately, and automatically they will also demand this in the higher duration segments also, over 3 years, 4 years, 6 years, 8 years, 10 years and higher than that. But it will happen gradually. It will not happen immediately. I will explain this in another video. What happened is that there's something known as the yield curve, where the yield is plotted with it for different durations. I will explain this with a graph in the next video. So what happened is, in the long-term segment, people have been talking about a possibility of a rate hike for several months now, at least for a year now. So the long-term gilt funds, they did not get affected that much. I mean, they did get affected, but it was not a dramatic fall. In the middle portion of the duration segment, over few years, over 3 years, 4 years, 5 years, 6 years, over that segment, that segment was a little bit shocked by the sudden decision, and the yield increased. That means the price fell. The yield of the current bonds increased, so the price of the bonds fell and the NAV fell. In fact, I had posted in another article today that the funds which fell the most, they are not gilt funds. Some of them are banking and PSU funds and so on. Of course, gilt funds are also there, but they were not the toppers. And so what will happen now is that slowly liquid funds will start buying new bonds with hopefully better interest rates. Money market funds will do that. Overnight funds will first benefit, then liquid funds will start benefiting, money market funds will start benefiting. Gradually the benefits will start moving across the duration segment. So in the coming years, if the rates cuts persist over a few, if there are a few rate hikes persist over the next few months or even a couple of years, then we can expect the short-term segment, liquid funds, money market fund, to do better. Gilt funds will suffer. They may not crash, but they will have a sustained kind of not much return kind of a scenario. And so it's going to be a frustrating hold for gilt fund investors. I'll talk about that also in a separate video. So that's about it for this video. I'll continue talking about this in another video.